Welcome, everyone. Thank you for signing up for our first session of our speaker series this fall. Tonight being the first one, the plan is to hold one every month through, I think we have speakers lined up till at least April. And over the next couple of weeks, we will be sharing the full list of time slots and speakers that have been confirmed. So thank you for joining our very first one. Tonight we have with us Steve Duff. As many of you know, Steve is the chief economist with Ontario Ministry of Agriculture, Food and Agribusiness. And Steve, has a background in agriculture, continues to works with his own farm. He's got cash crop as well as beef in I'm going to just say the Northumberland County area. And so that keeps him attuned to some of the things that we're certainly interested in. So tonight, Steve is going to speak to us on the current sheep situation here in Ontario, and some outlook as well. And generally, Steve covers off some discussion on some of our key players in our industry, being the U.S. and some of our international importers as well. So, Steve, thank you for starting this speaker series off for us. A timely topic. Normally, Steve would give this presentation at the AGM and convention, but this year we've put him into the speaker series. So, Steve, take it away. And what we will do in terms of questions, if you have questions for clarification purposes, we will take those as we go. For questions that come out of Steve's presentation, I would ask that you either type them into the chat box or write them down, and we will have a question period at the end. So with that, Steve, the microphone is yours.
Thanks, Anita. I appreciate the introduction and appreciate you guys having me out again to talk about the sector. It's an important one, it's an interesting one, and hopefully we can give you guys some good information to understand where things are at and give some idea for the coming year. And as Anita said, feel free to ask questions and we'll talk about them at the end, and then the presentation can be made available as well for everybody. The other thing I think that might be interesting for many of you, I guess, is that because I see some familiar names on the list. From the AGM, normally you're looking at a screen that's quite a distance away. This is going to be one of the times in a while where you'll see it up a little bit closer, assuming you've got the computer screen in front of you. So hopefully you'll get to see some of the numbers pop a little bit more. I find in a lot of ways the stuff I do in some ways is almost better in a virtual world, only because you can see that stuff closer. So as Anita said, we're going to talk about the U.S. It drives much of, not all that we do in pretty well all of our sectors in Canada. And that's going to continue to be the case over the next while, especially as we see some issues and changes over the next 4 years if with the new government in the U.S. and what that means. And it'll be a pretty dynamic environment. And when I do presentations like this, I'll often again talk about the U.S. and we'll often sort of, as an economist, say that's about price determination. That's what kind of drives the market. And then you get into price discovery, which is, again, when you're dealing with the auction system, when you're dealing with direct contracting, that kind of thing. And I'll try to touch on those because, again, when you're in a situation like we are with the U.S. right now, where you've got a new government, and a president that's talked a pretty big talk about a bunch of things, and it appears that he may be inclined to do some of those things, and they may have a negative impact on us. There's a lot of noise in the market that, again, can set that determination side of things. So we'll cover that off, and then I'll try to do a bit of an outlook. Politics aside, this map probably drives much of where the next couple of years is going, and it's driven the last few years in a lot of respects. And that's basically that of the U.S. Drought Monitor. This is updated pretty regularly. You can go on, the link is here, and get it and check it out. And there's ones for corn. There's a variety of different ones that you can look at. But all across the U.S., they're in a pretty significant state of drought right now and for this time of year. And so if you look at the corn and soybean areas, they're at about 80% drought, which again has sped up harvest. It's sped up harvest in Ontario in terms of dry weather. But that can mean some challenging things if this continues through the winter and into the spring in a variety of different ways. 60% of the winter wheat area in the U.S. is in drought. And one of the things, again, about the U.S. that is unique certainly compared to Ontario, is that they're not really a three crop rotation industry in the U.S. The bulk of the middle of the U.S. is largely corn and soybeans. The plains and the prairies is largely wheat and grains, almost like it is in Western Canada. So when winter wheat's in drought, that can mean changes in overall production in other commodities as the spring comes on, because if the winter wheat isn't planted or if the winter wheat doesn't overwinter, they're generally not planting the spring wheat in many of those areas. They're into something that's a little bit later season, and that could often mean corn and soybeans. And so there's a dynamic, and we've seen this over the years in the U.S. So that's something to watch, and that affects feed grain prices, et cetera. The other one is that based on this particular graph, about 50% of the sheep inventory in the U.S. right now is in a drought condition, 65% of the cattle and hay areas. So when that happens in the U.S., again, very, very large portions, especially to the south, to the middle, through the Texas Panhandle, et cetera, of the United States, um, they basically are grazing year round. And so when you are in a drought situation, in a wintertime situation where, yes, their cattle in this case, the sheep are still out, but they're basically dealing with stored feed on pasture. To be in a drought situation this time of year and as you move into the spring can be a real challenge in a variety of different ways. And what we've seen, especially if you go back to 2012, with some call it a great drought, in fact, but that ended up with significant liquidation both in the cattle and the sheep herds sheep flock through that grazing winter period, which brought a lot of production and meat into the system in a relatively quick way, which had some short-term price changes in the market, but also meant and set up basically a period of decline as far as the U.S. flock and the U.S. cow herd. So this is really something to watch and will have a big impact on us. And then, coupled with that, droughts and hay inventory short, price of hay going up, that kind of thing, all plays into a market that's basically, pressuring as far as production goes. And so like us, the U.S., flock has been basically in a steady state of decline. And you could say the same on the cow herd side of things, really, both in Canada and the United States. And there's a variety of factors at play there. One of the main ones being this sort of competition for land, these two industries based on grazing, as opposed to the ability to do contained feeding like we see with pork or chicken. I'll talk about that in a minute. These numbers are based on in the U.S. case on July numbers, and they're down about 1 to 2% in 2024. So the sort of continued decline, and that also then means that you've got more older animals coming into the feeding system or into the meat system, and that in turn has bumped up a few things, and I'll talk about that more in a second. The U.S. again is in a pretty unique situation, and again, to some degree, the stuff with Donald Trump may affect this a little bit, but they've in the agriculture sector, they've come to very much rely on exports as a key driver of their industry across grains, across livestock, dairy, poultry, you name it. They are efficiency driven. They are, effectively driving themselves cost production wise to the lowest level they can, and in doing that, they're relying on exports to deal with excess when they have it. That said, they are in a huge consumer of everything because it's such a large country. They're a high income country, and they're also one of the more efficient, if not the most efficient country worldwide in terms of agriculture. So they're also a least cost producer. So they have a unique set of advantages compared to any other country in terms of agri-food. If you look at their contained industries, the ones that rely on corn in particular, but they're done in a contained feeding system, pork and chicken, they're producing, 50% or even higher now over the last 25 years of what they have. And so they've done that basically through improving feed efficiency and growing export markets to manage the fluctuations. Beef, on the other hand, is down and continues to fall. And again, lamb and the ewe flock continues to be the same. And that plays out into a number of things, I think, in the sort of the overall meat complex in the US. But even in the beef and the lamb industries, exports are still a fairly significant thing for them to sort of manage some of those challenges. So what are they looking for as far as going through 2025? Well, as I mentioned, we've got drought conditions that's pressuring the flock. It's pressuring the ability to either overwinter your current flock, to contemplate having more replacements and feed more animals to try to build a larger herd as the next couple of years go by. The numbers would suggest right now that, we're almost to the end of 2024, that overall production of lamb and mutton would be up about 1%. So effectively flat, but that's largely due to sort of, again, a slight contraction in the amount of ewes and replacement lambs that are out there. And they're expecting that little bit of a 1% to increase their exports about 9%. Now, again, the US is importing large amounts of lamb from Australia and New Zealand, the same as us. And so they are in that case competing pretty specifically what is the world's least cost producer. Um, but exports still in that sort of side of things is an important release valve for the U.S. and some of that plays out in a lot of different ways internationally. They're expecting land prices to have risen about 4% on average over the year, with a fairly sort of normal set of seasonality that would occur, not unlike what we have here in Ontario. It tends to track fairly closely. And then they're expecting 2025 production to decline upwards of 5%. Now that's a little bit variable. I think they are anticipating in that number some further reductions in inventory and the flock due to the current drought situation. If the drought situation gets worse, in a month or two, if that's by the time you hit Christmas or January, if that's still at 50% or 60% on that drought map earlier, then this production will likely rise just a little bit, and then that'll further pressure prices. So again, I think in general, from a US point of view and the extent to that which that pushes our industry, again, seasonality continuing kind of the way it has been, and I'll come back to that in a minute, but really no downside as far as the US pressure goes towards our market, which is pretty significant, I think, from the point of view from producers looking forward on lambs. As I mentioned, hay prices are likely to be pressured pretty significantly on the feed grain side of things for corn, soybeans, and wheat. We're now basically looking at about 3 years in a row where the U.S., at least on average, would have been producing below cost of production for their corn, soybeans, and wheat. And so in the US model, that usually pushes them to reduce overall acres. And we've been kind of gradually seeing that. So 2024, basically slightly lower acres. And again, when you talk lower acres in the US, their lower acres can be as much as our entire 9 million acres in crops in Ontario. So the kind of scale that they bring to the table is really sometimes kind of hard to fathom when you really sit down and think about it. But they're going to have to ratchet back production in terms of acres in the next year or two. In 2025, the crop will be planted next year. The winter wheat crop that's being contemplated or already in the ground right now is going to have to fall if they want prices to rebound and if they want to try to get themselves above that cost of production, which for the most part isn't really declining, as most of you would know. Even though inflation and cost increases have flattened or improved somewhat, price levels are still very, very high. And so, for the most part, we've seen one of the bigger declines in sort of a year-over-year format the U.S. has seen in 40 or 50 years, really. We're down upwards of 30% compared to the peaks of 2022. And it's likely that in the crop year that we're in right now, so again, the way grain and oilseeds works is it goes on a crop year basis as opposed to an annual basis. So the crop year for corn in the United States is September of the fall through the following fall. In our case, it's October based on harvest, and the same for soybeans. So you're kind of just into that marketing period now, but the pressure is likely to have seen at least another dollar drop or more over on corn over the next year. Slight rebounding in 2025 would be the expectation, but again, that's on the basis of we see ratcheted back production, and that's on the basis of sort of normal yields. And one of the key challenges when you look at the U.S. and the excess that we're kind of in right now, and the market is trying to deal with that excess, is are we near or at what they tend to call trend line yield? So for example, in corn, the United States trend line yield is 181 bushels to the acre. And that'll be the number, or roughly the number they're looking at going into next February. So when they're talking about next crop year. And so as the summer progresses, if corn is being projected to be 180, 185, 186 like it was through much of this summer, then that's going to put further pressure on prices downwards because there's the expectation of having more around, and the market has to deal with that, and the way they deal with it is lower prices. Goes below 181, let's say it's down to 170, 175, maybe the drought continues, we have poor emergence, that kind of thing. It can kind of go the other way. So this is very much, there's a lot of uncertainty in the market in these scenarios where you've got basically large inventories around and you're trying to deal with it. So, again, looking at what this means for us and how it's affected us over the last year. We've continued to see overall demand for meat grow. This is a combination of a few things. One is the growth of population. That's been a big part of it, and that affects, the sort of the diversity of what people eat. And I think lamb continues to be in an advantageous position in that regard. The data is a little bit more difficult to sort of suss that out, I guess, just because of the nature of how StatsCan produces things. But certainly at a more local level, I think you can pretty clearly see that. Demand for lean protein is growing pretty significantly. We see that in a variety of different things. Say University of Guelph does a lot of consumer panels, that kind of thing. Lean protein fits within that as a really high demand model, and lamb, I think, fits into that model, although maybe, in a slightly different way than, say, lean ground beef, which has a number of other different sort of characteristics about it. Per capita demand for lamb has grown only about 1% over the last 10 years. And one of the challenges with per capita demand is that it's a function of a variety of different things. And so, it's not really increasing significantly, but for some groups of people, it is a significant thing. And I think that's one of the things that's maybe a little bit more unique about lamb versus ground beef, as an example, where specifically a lot of people are consuming it in a fairly consistent way. Whereas with lamb, you've got large groups of people who would consume a lot more lamb per capita than others, and that in turn creates an opportunity to try to meet their demand. And so it's a little bit more unique than some of our more typical commodities like chicken or beef or even pork. But what we have seen on the left-hand graph is, in the Canadian context, the thousands of tons of demand for lamb increasing as time has went by. Again, despite this relatively flat per capita, because again, it's facing higher population rates, and that turn means there's more demand out there. And that's a really significant thing to think back to. And again, this is a pretty common story that I'm presenting. This has been the message I've been saying for a long time, but it's the reality of this sector, and I think it continues to be the reality, and one that I think presents opportunities. That said, we do rely on imports pretty significantly in a variety of different ways. And again, this isn't unique to lamb, and in that context, this is, in all of our commodities, we import product even when we're exporting, right? We're importing pork despite the fact that we have so much extra pork and we export a crazy amount of it. It's the nature of our food system. It's the nature of kind of the just-in-time food system that we have. But again, imports are a big part of our system. Again, at the national level, we're at about right now, about 55% of our total demand is coming from imports. And again, that's not really unexpected, I think, given some of the declines. But that percentage, if you look at over time, has remained relatively stable in anywhere between 45 and 50% in that kind of range. And so Again, it's a function of a variety of things. One is that we've had some consistency in the volume of lamb produced domestically. If you look at the Ontario numbers, we're importing about 100% of our consumption. In fact, over 100% of our consumption. Now, again, we're a major movement area for a lot of production. And given that the majority of our domestic lamb processing is done in provincial plants, then any movement that our plants would need to do or our wholesalers, et cetera, would need to do, are going to have to be done from international products. So that's also one of the interesting things there. In 2023, lamb imports at the Canadian level were down about 17%, and demand was relatively flat. And one of the things that's relatively common in this sector and some others is that when you have a down year in imports, from a volume point of view, and I'm talking volumes here, oftentimes the next year will kind of reverse itself, and we're really seeing that year-to-date lamb imports are up, not quite that, but pretty close. And so again, like the US, while we have a fairly, even though it's declining, it's still a relatively steady ewe flock, at least in the last number of years. And in the context of where we fit, we're competing against an international competitor who is large, who has year-round grazing, who has some significant competitive advantages in that regard, but is a long ways away and is producing a product that by definition then can't be as fresh and as local as what we can, certainly in the Ontario market. And so again, I think that's one of the key advantages that the lamb industry in Ontario has relative to imports from Australia, New Zealand, and even other countries where we do get some, particular Ireland, a little bit here and there. And so again, when we talk about industries like this, we're a small importing country, so we're facing stiff competition, but we are able to fairly easily differentiate our product. Our product is clearly different. However, it's more challenging for our product to meet the retail side of Canadian meat because, again, the majority of our product is provincially processed, can't move between provinces. In our retail sector is highly concentrated and for the most part is nationally based. So there's a lot of product movement. So that can be a challenge for us. But again, I think given that imports are relatively stable, and sort of in the long run, as far as New Zealand and Australia are concerned, again, as I've said this many times when I've done this presentation, I think that is a signal of the strength of the demand for lamb. And again, with these other factors at play, the growing population, the growing demographic in that population that demands lamb, and a clear advantage from a freshness and quality point of view to Ontario lamb. Again, I think that continues to be something that we can build out. So year-to-date numbers, again, after having fallen, which were largely on the back of Australian imports, they were the ones that were really down the most, if not completely last year. Values were down as well. We're seeing that rebound. And again, that's not uncommon. And it also, again, goes to this idea of relatively flat demand sort of in aggregate in that period. So as I mentioned, again, we've got our ewe flock specifically lowest on record right now. Western Canadian ewe flock shrank about 1%. Quebec one grew. Those are basically flat numbers as far as I'm concerned. Ontario's was effectively flat. Our Ontario and Canadian replacement land numbers declined 5%. Again, these are tricky because you've got a lot of choice at certain points with replacement inventories. And again, like in the US, they can quickly move from being a replacement lamb to a market lamb, depending on feed availability, et cetera. But what this does point to, again, is not significant amounts of increase in the numbers, basically flatline numbers, and that turn means the ability to meet growing demand is we're kind of at our capacity at this point. And then when you take that to the next step in terms of what it means for prices, it basically means that the market is going to be clamoring for those animals. And so again, it is a unique industry in the context of federal slaughter is basically non-existent. If you contrast that with all of our other meat industries, whether it's beef or pork, et cetera, in their cases, the vast majority of the animals are through federal processing. The vast majority of those animals are direct to contract to packer. which again is not the norm, certainly in the lamb industry, although it's got some presence, which again I think has some advantages to it, but also some challenges and risks. Slaughter rose in 2023 by about 10%, and we're up year to date about another 3% based on my math. So again, you're bringing through some of these replacements, et cetera. And that's where when I say that effectively the numbers are flat, they might even be down a little bit based on slaughter. But again, with interprovincial movement being what it is, there's some challenges there to try to get a good handle on that. And that, as you guys are probably well aware, continues to always be a little bit of an issue for us. Because again, we're a small price-taking country to the United States, but again, we don't have a futures market like we do for cattle, corn, hogs, etc. We do still arbitrage the United States, which means if our prices get too far out of whack in an open trade environment, which we have, I know we don't move a lot, but it's still open and has the ability to free flow, subject to transport. If we get too far out of whack, we're gonna see movement. And so over time, the Ontario land price does fairly closely follow U.S. prices. Again, you're dealing with two different auctions, whether it's the Missouri price or the Ontario price, and auctions are not the same as a board price like it is for corn or soybeans. So, there are some interesting things in there. But generally speaking, we do track fairly closely, maybe a little bit steeper spikes up and down compared to the US, but they tend to move in unison. And in the last several months, one of the more unique things that we've seen, which is not uncommon, but it's certainly been the case, is that the Ontario prices have fallen a bit faster in this period, which again is sort of the normal period of decline that we'd have seasonally, fallen a bit faster than the US. And so again, that reflects in a few things. And so in the trade, when we look at basically comparing markets, we often will look at spreads or basis. Um, and this is again something that you can do even as an individual if you're selling into a market. Normally, for example, if you're selling direct to packer, you can compare your prices to local auctions to give you a guide, or you can, even go and get this information from the USDA if you wanted and sort of track it to see where your own numbers fit against that. And certainly in cattle, a lot of people do that. But basically, you've got seasonality that comes through the grazing period, and the basis basically, which again is the difference in this case between the Ontario price and that Missouri price. Um, it will tend to move and reflect weakness or local demand. And when we talk about basis, for the most part, basis is normally when you're below your sort of reference market, that will tend to mean that you're on an export basis to them. Your price is lower, and that means product is tending to move to them. Tends to mean you have excess, or could also mean that demand is sort of weakened in your local area. And when you have excess and when you have a shortage and when you're importing, you'll tend to be plus that reference price. And so that's generally the case for Ontario lamb, because we're importing overall meat, that will tend to reflect in terms of the live price. And so what we tend to see is for the first half of the year or so, as we're, approaching that grazing period and hitting the middle of the summer, will tend to be, a fairly strong positive basis upwards, depending of what the normal is. But the dotted blue line is sort of your average over the last 5 years. But usually by about May, that basis peaks at about $140. Again, this is in Canadian dollars compared to the US. As you hit the middle of the summer, at times it'll get close to an even number, which it did in 2023, but on average it gets about as low as $40, 100. And then it'll sort of rebound back up through the fall and the end of the period as we head into Christmas, and we head into sort of that, in our case, that contained feeding period that, again, the US oftentimes doesn't have. And so that's why their seasonality tends to be a bit flatter than ours, because they don't have that same kind of overwintering. What we've seen based on the dark line in 2024 to date so far this year is, for the most part, the first half of the year where that basis was fairly seasonal. And one of the key things you're always looking for is, how far below or how far above are you? Is it sustained? Does it jump around? And again, in the auction system, which largely drives the data here. That can be a challenging thing because auctions have, as I mentioned in the bullets here, they can push a bull, up or a bear down run, pretty easily. There's a lot of, life to them. But the first half of the year, we were just a little bit below average. Excuse me. And then since then, we've been rebounding, and that is showing, we're above the average, about the same as we were below the average last year. And so that would tend to mean that on average, we're seeing either significantly higher demand or we're seeing an expectation of lower volumes of animals coming through the system. That takes you to basically the end of October, and then we'll see where the next month or so goes. But I'm anticipating that right now to continue and then sort of get back to that 5-year average as we move into the new year. On the retail side of things, again, lamb prices are a little bit challenging. StatsCan doesn't really do any kind of lamb reporting like they do for other commodities, so you kind of have to track it yourself. And again, if you're somebody dealing in the direct consumer trade, it's important that you think about where you would want to go in that context and track either, some local producers who are similar to yourself. A lot of people will have their prices online, local retail stores, that kind of thing. But this basically, what I've been tracking for quite some time is basically 3 sort of key prices from grocery stores across Ontario for a specific retail chain to try to be consistent. But they'll tend to offer basically sort of 3 products. So we've got the light blue line, which is pretty much consistently higher as we would expect from the imports on a fresh basis, and we've seen over the last year or so, about a $5 to $6 per kilogram increase at that retail level for Ontario fresh. You got the dark line, which is New Zealand frozen, which is pretty steady. And one of the things you do see is that doesn't always track with import prices. So, basically the retail chains are adjusting their margin on the product and trying to keep the price relatively similar, where it would seem with the Ontario stuff, they're trying to adjust a little bit more to the market. And then Australia Fresh, which has seen a bit of a drop in the last year or so, which again coincides with some of those reduced import volumes that I referred to earlier. Either way, you've got relative sort of stability, relative prices between these 3 competing products staying relatively similar. Again, from my perspective, in a lot of ways, I think you're dealing with fairly different product markets as far as the Ontario product versus New Zealand and Australia fresh markets. So again, I think that's continues to be an advantage for Ontario. But again, if we get too far out of whack with those 2 retail prices, people will substitute, and that'll continue, I think, to be a challenge for us to think about as time goes by. In terms of looking at the market and where things are going, if you take that sort of USDA forecast, there's 2 sort of ways that you can look forward. One is you can say, well, if the USDA forecast, is their forecast of where prices in Missouri are going to be over the next year or so. And if we apply this 5-year average basis that I was referring to earlier, that dotted line on the basis chart, you're going to superimpose that sort of seasonality on it. But from Q4 of this year, so where we are right now, depending on your perspective, the blue line would be the light blue line would be that 5-year average basis, and that's a fairly sizable increase through to the first quarter in 2025. That again is going to reflect strengthen the market and basically a shortage as far as the lambs coming through the system goes, tied with that high demand and the seasonality that Christmas tends to bring. And then sort of a gradual decline through to the summer, and then a rise back as we approach next fall and next Christmas. This is one of the few years that I've done this presentation where the 5-year average and the current basis are fairly close. And so current basis is sort of just projecting forward based on where the USDA would see their prices changing. It's really not reflecting that maybe through the course of next year, for example, we're short lambs, et cetera, which would tend to widen those gaps. So, I think for the most part, a fair bit of stability, not some of the, more significant numbers that we would have seen exceeding 400 on the hundredweight, that we might have seen a while ago, but, sort of peaking at that point and staying right about where we are now. We're pretty close to that, at least from an average point of view for the rest of the year. again, there's ranges around this, and that's one of the challenges around livestock and auctions in particular. And that's also something that you need to really pay attention to. When you're dealing with any kind of livestock, the range on a particular sale is a really important tell, both about your livestock as well as the demand for the livestock at that sale. So if you're consistently, for example, when we teach this stuff, the producers, if you're consistently at the bottom of the range, that's likely a function of a few things about your livestock relative to the rest of the group, or the rest of the animals that are being sold at that point, even though maybe you are, dealing with 5-weight cattle, for example, or 5-weight steers, the range in that is quite different. And it's important to be sort of introspective in that regard. And that's why, for those of you that were at the AGM, Sheep Farmers AGM last year, where they did the carcass evaluation, the lamb evaluation. Again, as somebody that sold a lot of direct-to-consumer beef over the years, I've mentioned this before, but it was a fascinating thing. I kind of wish the cattle guys would do the same thing. A little bit different, but a similar concept. And to me, it was a real tell on the kind of things that play into this idea of range in an auction, which again is a lot different in other commodities. It's a lot different in fed cattle as well. So just to kind of reference that. And so to wrap up, where does that kind of go? So I tend to use a reference on sort of the cost of livestock and feed going into each lamb at about $175 a lamb. That's kind of where I am right now, is sort of a normal cost. And then that is producing that's kind of what I call a feeding margin. That in turn gives you a return to then cover your overhead costs on your farm, as well as land costs, and provide you potentially a return to your own labor within that. And so, essentially what we're seeing here is following that trend, recognizing that lambs are, largely kind of more of an annual product like calves, as opposed to something like feedlot cattle, for example, that are, on a more of a semi-annual, or hogs, which are on a triannual basis. But basically, sort of on average, about a $65 to $70 return, depending on whether we're at the average basis or the current basis over the course of the year. Again, so not really historically high returns, or profit, again, return to these costs, to cover these costs, but still positive, and I think still signaling that there's opportunity there for producers who can either, beat that cost, can take a retail dollar through a direct to market model, etc. So again, I almost feel a little bit like a broken record for this outlook in a way, because the fundamentals of the market really, from the most part, haven't changed in quite a number of years, right? We have, again, to wrap up, you've got really nothing significant in the horizon in terms of big increases in the amount of lands coming through. So there's not a ton of things that you would say should really fundamentally depress prices in the future. You've got weather that's playing probably against the sector, at least in the US, than it is in the positive side. You've got growing demand in total, but also some very concentrated demand in certain parts of North America, and Ontario being one of those key markets. And again, in our case, you've got the bulk of our production being through a provincial system, which focuses our production on that market. I think is, again, both an opportunity and a challenge. Again, I'm not trying to suggest that it's all roses here, but it continues, I think, to be an opportunity for the sector, and one that, I think a lot of people have seen. I see a lot of people trying to take advantage of that. Again, it's not easy selling meat. I know it firsthand, but it is something that can be relatively profitable depending on the business model. And again, I think the fundamentals are there to sort of buoy that for the coming year. So with that, I'm going to stop talking, and I'll let Anita read the questions from the chat, and we'll go from there.
Thank you, Steve. Folks, any questions for Steve, either raise your hand, or if you prefer, you can certainly type those into the chat box, and we will read those out. And while you're thinking of maybe some questions or typing, Steve, you commented that in at least in the near future, you don't see any big changes in terms of supply of lamb coming into Canada. And I don't know how many folks follow what's going on in New Zealand and Australia, but I would suggest that the weather that that New Zealand has been dealing with during their current lambing season, at least in the Southland, they're certainly not going to have a bumper crop of lambs this year because of excessive wet and cold, right? So not good for them, but um,
Yeah, the weather isn't, cooperating in too many places in the world right now, right? We might be one of the few like that has relatively stable weather, So when you're dealing with a grazing based industry, to your point, right, it isn't all just about dry. It can be wet, can be a major issue as well. And yeah, I don't see anything internationally from a lamb point of view that's really would say we're going to have massive amounts of additional lamb around in a year or two. Do you know what I mean? So we're kind of playing in what we have in a price taking industry like we are in Canada. And this isn't just in lamb. This applies to a lot of stuff. Like again, I was at the Maritime Beef Conference in Moncton on the weekend, and it's a similar concept down there with beef cattle, right? They're dealing with a relatively small number of cattle for their area. They're bringing in a lot of production, internationally, interprovincially. So everything they can do to sort of offset that is a benefit to them. But again, it still comes down to individual producers. This isn't something that, the Maritime Beef Council or the Sheep Farmers of Ontario is going to do for you. You got to do it yourself, right? So,
mm-hmm. Yeah. So we do have a couple of questions in the chat box from Brad. His question is with regards to our extremely high coal prices at the moment. They've been fairly strong the last 4 to 6 weeks. Is there a certain season time of year that historically has increased coal prices over others?
it would tend to be the period where livestock start to come off grass. That would be the same that's the same basically for the most part in beef cattle. I know not necessarily in dairy cull cows, but in beef cattle, um, you'll see some volatility there. Some of which has to do with more coming in and just again, um, the demand for cull animals is kind of unique, right? Because they're a more specific product. You know, they're larger. Um, they fill a different niche, right? That's why, for example, in beef, Cargill and Guelph kills, most weeks a day of Quebec cull cows. But it's a specific beef. It's filling a specific market. It's not filling a market that the corn-fed steers the other 5 days are
Right.
covering off. And I'd say that's the same here. The other question is about volatility in lamb prices. Again, I think the likely scenario is that, one, it's going to pressure prices up, in my opinion, and then the remainder of the year. What that can mean, however, is there's a more of a range because you'll see increased volumes coming through, but also um, I think that's where you'll see where the quality of the animal reflects more in the range of the price or the market, the auction market. So you can see more volatility. Volatility is a relative thing in the auctions, right? Like again, if you're pricing corn, it's a considerably different thing than pricing lamb because of the nature of how an auction works versus a board price for corn.
Steve, I guess I just want to follow up on your comment there with regards to the I'm going to say being more selective on quality paying. Quality lambs would bring the stronger prices when our holidays are lumping up together as Eid moves into the early part of the year. Um, and now I've lost my train of thought. My apologies, but the a lot of that has more to do with the processor's ability to to take the added demand for those markets on top of what the regular demand is as well.
Yeah, yeah. Again, it's from an auction perspective, it's a unique industry, right? I always use the example of cattle, but in fed cattle, we have couple live rings in Ontario where the cattle are going for slaughter, but the volumes are really low, right? Whereas in lamb, the bulk of them are going for slaughter. So to your point, when you have a period of higher demand where packers are either facing larger volumes coming through or they're trying to change, what their offerings are because of, holidays, religious holidays, that kind of thing. You might have days where, it's more just a timing thing and a packer had, you know, I don't know, maybe they had a power outage and they're short cutting and the cooler space is full. Like it's a sequence of a chain of events in that model that I think in provincial plants you see probably more than you might in some of the bigger plants because at least in my experience, certainly with cattle, um, they're running a lot more tight as far as their cooler space, their hanging space.
Yeah. Other questions for Steve? I know, and this is a few months ago that I looked at this, Steve, but you know how we Stats Canada tracks the frozen stock, what do they call it? Frozen
Yeah, cold storage.
cold storage.
Yep.
Um, we're sitting with lamb almost at an all-time low right now certainly compared to the last 3 and 4 years. Um,
Yeah.
can
Yeah.
you
That.
can you
Yeah.
comment on how that may impact our live prices here in Ontario?
Well, again,
I know
there's a
it's
few
speculation, but
there's a few pieces about that. One is that those are uh, especially in lamb, those are surveyed numbers. So I think that you'd want to read them with a bit of grain of salt. Whereas if you were to deal again with pork or with cattle, the bulk of that cold storage is in the hands of one or two major processors. So to survey and get their numbers is more accurate. You know what I mean?
mhm,
But that said, I think that when you're dealing with a market where you don't have as much lamb around, where it's clearly a fresh model, you're going to see cold storage numbers, dwindle to the point where it wouldn't surprise me if there's almost none in cold storage. Just the nature of the demand for the product, right?
mhm,
So again, I think that's to be expected. I don't know that it necessarily um, again, that number specifically, I don't know that it necessarily changes the price in the market because again, I'm not really sure it's that indicative of a real measure of storage, if that makes sense. I think I don't put a ton of weight in it, I guess is how I would describe it. Again, for lamb, given what I know about lamb and the nature of provincial plants. So as far as the feed costs go, this is basically based on data we have for sheep operations, a really large range of them. Not necessarily what we use for the risk management program, but somewhat similar, trying to look at all costs and then trying to sort out the costs related to feed and purchasing livestock, et cetera. Everybody's is going to be different, and feed is a complicated one because you're dealing with a grazing industry. Um, for the most part, a lot of people their feed costs are largely tied up in pasture as opposed to in purchased hay as opposed to high moisture corn and that kind of thing. So again, this would be an example of it's just sort of an indicator. It's went up. Um, normally, I in the last few years would use about 145, and so it's went up a bit. So the second question, no, sorry, first question about it comparing to prior years. So like a lot of things, it's went up. Not fairly substantially, really. But again, I think in your case, even more so than in maybe other sectors, I think it's important to, and John Molenheis, who works with the ministry, is our lead on this, but understand your own cost of production and figure out what that means for you, because that's everybody's is different. They're really, in a lot of ways, to try to say there's an average is not all that accurate. We kind of have to, given the nature of a presentation like this, but the reality is that everybody's different.
and just to be clear, that 175 is the cost of the lamb plus the feed cost.
That is correct.
Yeah.
Yeah. So if you look at the graph I'm showing here right now, the Q1 2025, the light blue line is the return if we stick at the current basis. So you're making basically $80 on that lamb after covering the cost of the lamb and the feed, and then basically that's left to pay overhead on your farm, property tax, and a wage to yourself if that's how you do it. So that's not a huge amount of money, right? But it's still relatively strong compared to past years.
Last call for questions, folks. Seeing no raised hands and no little line telling me someone's typing. Um, Steve, on behalf of everyone here in attendance and Ontario Sheep Farmers, want to thank you for presenting to us again tonight. And as I mentioned at the beginning, this is the first of our speaker series. The second one will be Wednesday evening, December 13th. Still making final arrangements with the speaker there. And we do have our speaker confirmed for Australia. For January. But as I say, we will promote those out through social media and the messenger in the next week or 10 days. So again, Steve, thanks so much for joining us and starting our program off with your presentation on the lamb industry.
Thanks, everybody. Have a great evening.
Good night, everyone.